Hi everyone, Michael from Bullion Now, bullionnow.com.au. One of the things I particularly enjoy about with working here is the conversations that go on both between ourselves in the office here and also customers that come through the door. So I encourage you, if you're in the neighbourhood, drop in and join our discussions, because some of them can be quite interesting and entertaining. But one that we've been having frequently lately is the gold-silver ratio and how it's so far out of whack, yesterday it was well over 92 to 1 in the gold-silver ratio. So just as a quick sidestep, the gold-silver ratio, in case you don't know, is you take the gold price and you divide it by the silver price. So effectively what you're saying is for every 1 ounce of gold that I buy, I could get 92 ounces of silver instead. So that ratio historically is generally considered to be around about the 50 mark, 50 to 60. But if we go back into biblical times, you can even say that the ratio then was back almost at parity. So why is the ratio changing, and what does that mean for us now? So one of the main reasons in modern history that ratio has changed, in my personal belief, again we can argue about this as we do in the office, one of the main reasons is the fact that the uses of silver have changed quite a lot over the years. So back, if we go back into biblical Roman times, it was definitely a currency. It was also used for many other things industrially back then. And then as we move through to more modern times, we see it particularly used in medical industry. We saw it used in the photographic industry, and we saw it used in the currency right up until probably the late 60s, early 70s, where it was really starting to be phased out, and we saw the reserve banks get rid of their stocks of silver. We saw places like the US repeal some of their laws that required their government to buy silver from their domestic miners, and that's a whole nother argument as to whether that should be put back in place or whether it was the right thing to remove that particular legislation. So we've now come to modern times where we're seeing that silver is no longer that quasi-currency that it was. It's lost some of its industrial uses. It's no longer used very much in the photographic industry, as that's changed to digital now and things like that. So is the gold-silver ratio still a valid measurement? And there are some that would argue it's not. However, I don't think you can completely discount the gold-silver ratio. Yes, silver is now very much an industrial metal. It is no longer that quasi-currency we used to talk about. And so it has the same price charts as an industrial metal should. So we see as demand increases, price goes up. As demand decreases, price goes down. Poor old silver has another thing that weighs it down a little bit, in that it's not usually, it is sometimes, but it's not usually mined as the main product. It is usually a byproduct, which insulates it to a degree to some of the price movements. So, quite a lot of the silver that we see produced today would still be produced whether it had any value or the current value, because it's going to be dragged out of the ground when we mine for copper. It's going to be dragged out of the ground when we mine for zinc. It's going to be dragged out of the ground when we mine for gold. So to a degree, it's almost price insulated. If the price went down, it would still be produced. However, realities of life is that if it did get to a point where it was uneconomical, it would just be discarded, along with a lot of other things, ores that are discarded during the production of the metals that I spoke of previously. So there is a base level there, but it is a little bit more insulated than some of the other metals that we see, industrial metals that we see. So that is a price pressure in a way, a price pressure downwards. But there is also still, to this day, a tie to the gold price. Now, why do I say that after I've just argued the fact that there won't be? Well, we all know a common term that silver is a poor man's gold. So as we see this flight to gold that we're currently seeing, the flight there when there's when there's increases in concern for inflation, increases of risk of recessions, things like that. We see that price to gold because that fleeing to gold. Once gold starts to get up there, as it has now, it's cracked through the $2,000 Australian level, it's cracked through the $1,400 US level, we see people look for alternatives. And one of the alternatives is the poor man's gold is silver. So in that, silver, no matter what, will be dragged up. And so I'm of the firm belief, and most people are around us, I think, although some people disagree, I have to admit, that we will see the silver price dragged up as the gold price is dragged up, and that silver to gold ratio will come down. Now, whether it comes back down to the historical 50 to 60 level, whether it comes back down to that 30 level that we hear sometimes, or whether it comes all the way down to biblical levels where it's a 1-to-1 ratio with gold, is anyone's guess. But there's very few people that I know of that would argue that a gold to silver ratio above the 90, or what I actually expect to see in the not too distant future, I think it'll actually get worse before it gets better, and I think we'll see a ratio above 100. So whether it stays that and that's the new normal or not, I would argue it's not, but it could be. I think though eventually we will start to see it come down again. Anyway, that's just an example of one of the discussions that's had around the office here. So if you're in town, feel free to drop by and join our discussions. It's 605, so it's level 605 227 Collins Street in Melbourne. So anytime you're in the neighbourhood, drop on in.